Welcome back to the Crynet GenShow. You are tuning into episode #65. We are closing out 2025 with some of the most significant structural shifts we've seen all year. This week, it's all about the global handover. While Bitcoin is taking a breather and stabilizing around the $90,000 mark after its massive run, the rest of the world is busy building the infrastructure for 2026. From the UK finalizing its landmark regulatory framework to Bhutan tokenizing its sovereign gold reserves on-chain, the message is clear. Crypto is no longer just a market, it's a national strategy. We'll also talk about Solana's Fire Dancer finally hitting mainnet and why BlackRock's Staked Ethereum ETF is the talk of Wall Street right now. We've got a lot to cover in this year-end surge. Let's get into the top 10 stories of the week. Okay, so let's unpack this crucial shift. The first thing that jumps out from your sources is this collective sigh of relief coming from legal departments everywhere. For years, we've been in that Wild West phase, a landscape defined by ambiguity and just, well, risk. And it seems like the most significant structural change of 2025 has been this global push for clarity.
It really feels like the end of that era.
That framing is so important, and it's backed up by hard data. The TRM Labs report, their global crypto policy review, they essentially designated 2025 as the year of the stablecoin.
The year of the stablecoin. That sounds really specific. Why are stablecoins the benchmark here for, say, institutional adoption?
Well, because they are sort of the lowest hanging fruit when it comes to regulatory agreement. The report found that over 70% of global jurisdictions now have active, enforced stablecoin regulations, rules for issuance, for reserves, for redemption. For big financial institutions, that clarity around transactional assets is the key. It's what unlocks everything else.
It moves crypto from this high-risk, unclassifiable thing to compliant digital cash.
Exactly. And that's what drives the institutional capital flow. It's not necessarily a new tech breakthrough, it's a compliance breakthrough.
And it seems like the UK is leading that charge. They seem determined to make up for lost time. They just published the final secondary legislation, bringing everything under the Financial Conduct Authority, the FCA.
Right. And this is more than just legislation. It's a full-on commitment to a framework. The UK is cementing that core principle. Same risk, same regulatory outcome.
That's the exact language investors want to hear.
It is. It's what the major global banks demand. If you offer a loan with a decentralized protocol, it gets regulated based on the risk of that loan, just as if it came from a traditional bank. The tech doesn't change the obligation.
But their stated goal isn't just compliance. It's pretty ambitious. They want to be a global digital assets hub by 2027.
Precisely. They're signaling that their rails will be compliant and strong enough to handle global institutional volumes.
It's not just happening in the UK.
Not at all. We're also seeing this targeted easing in the U.S. derivative space, which is, absolutely vital for the more sophisticated financial players.
Let's get into that. The CFTC, the U.S. derivatives regulator, issued this new no-action relief as part of its crypto sprint. This is the kind of technical detail that I think retail often misses, but for the pros, it's huge.
Oh, it is. It's monumental. This relief significantly broadens the ability for commission merchants, we're talking the big brokers, the clearinghouses, to accept non-securities digital assets, specifically BTC and ETH.
As collateral.
As collateral or margin, yes.
So explain how that specific technical change actually matters. To me, it just sounds like accounting jargon.
It's all about capital efficiency, and that is everything in institutional trading. Before this, a traditional bank faced, prohibitively high risk weighting when using crypto as margin, sometimes 100% or more. It just made it too expensive to hold.
And this relief changes that.
It standardizes the treatment. It lets them use these assets as high-quality liquid collateral, kind of like certain government bonds. It lowers that capital barrier, making derivatives trading in crypto just exponentially more viable for the big regulated players.
Okay, that sounds like a clear win for trading volume. But I have to ask, isn't accepting highly volatile crypto collateral a massive risk exposure for these merchants? What's the regulatory trade-off? Doesn't this just push systemic risk onto the banks?
That's a great question. The trade-off is standardization under existing oversight. The CFTC isn't just saying, go wild. They're standardizing how these assets are managed and held in segregated accounts. And the volatility risk is mitigated through required haircuts, meaning they only accept a fraction of the value.
And real-time liquidation processes, I assume.
Exactly. The goal is regulated exposure, not unchecked risk. It shows the regulator is finding ways to integrate these assets without waiting around for whole new laws.
And when regulation provides those compliant rails, capital moves. We're seeing that happen right now with some big geographic shifts. Abu Dhabi, especially after the Bitcoin MENA event, has become a total magnet for capital.
Abu Dhabi is the perfect counter-narrative to the U.S. wait-and-see approach. We're seeing a significant number of U.S. and European crypto firms announcing they're moving their regional headquarters to the UAE.
Why there specifically?
They all cite the clear, proactive environment established by the ADGM, the Abu Dhabi global market. Capital doesn't wait for certainty. It flows where certainty already exists. They're capitalizing on that global competition.
But it's not just about attracting foreign money. We're seeing nations use Web3 for their own strategic advantage. India seems to be making a major pivot after India Blockchain Week.
Absolutely. The focus for India has shifted dramatically from crypto as an investment class to crypto as a foundational public utility. The whole strategy is now about deeply integrating Web3 solutions into their national digital payments infrastructure.
What exactly?
Specifically, asset tokenization, land registry management, and streamlining cross-border settlement. This is the handover in its purest form, using the network to make a massive, complex national economy more efficient.
Okay, and this is where it gets really interesting, and it just shows you the global scope of this handover. We're talking about a sovereign state making a groundbreaking, highly strategic move that completely bypasses the traditional financial system. Bhutan, announcing plans to tokenize its sovereign gold reserves on-chain.
This development moves tokenization from, financial theory directly into practical treasury management, a national strategy. Just think about the implications. Bhutan is taking one of the most traditional, foundational, highly regulated assets, its own gold, and putting it on a globally accessible, decentralized ledger.
What's the primary driver for a nation to do something so revolutionary?
They're solving two core problems at once. First is financial transparency and immutability. An on-chain proof of reserve is auditable by anyone, anywhere. That builds trust in their sovereign fund.
And the second problem?
Global liquidity access. They get it without relying on legacy Western banking relationships. Global investors can trade these gold-backed tokens on decentralized networks, which provides access to capital that traditional finance makes slow and costly, especially for smaller nations.
That is a tectonic shift. A government literally bypassing the old financial rails for a fundamental asset.
It is. It's a profound statement about financial sovereignty. And if you connect this to the bigger picture, it shows that blockchain is now seen by state actors not just as tech, but as a tool for economic statecraft.
And speaking of large traditional entities embracing this world, we have to talk about BlackRock. The filing for the iShares Staked Ethereum Trust is significant, not just because it's BlackRock, but because of what it represents, bridging that gap between fiduciary duty and DeFi yield.
This is the product institutional investors have been waiting for. We spent years talking about how asset managers who operate under these really strict fiduciary constraints could safely access DeFi yields. You can't just connect a bank's treasury to a decentralized protocol and start staking. The operational and custodial risk is just way too high.
So how does the BlackRock ETF solve that specific problem?
It acts as a compliant, regulated wrapper. That's the key. It allows massive institutional clients to participate in network validation, so they earn that native staking yield from Ethereum, but without ever having to manage private keys or operate validators.
Or deal with direct protocol interaction risk.
Exactly. It turns a DeFi native yield, which used to be only for crypto-native funds, into a regulated product that's suitable for pension funds and sovereign wealth.
It de-risks yield participation. This product basically unlocks the next wave of institutional adoption for staking rewards because it provides a clear, compliant path.
That's right. It standardizes the risk profile, making staking rewards accessible to TradFi in a way that respects their stringent compliance needs. This product alone is why the whole conversation about ETH's future valuation has shifted. The demand side is about to see a massive compliant injection of capital.
Okay, but to handle that kind of flow, whether it's sovereign gold or massive BlackRock funds, the underlying infrastructure has to be exponentially more robust. So let's look at the tech updates supporting this global handover. Solana, in particular, just hit a major stability milestone.
That milestone is Firedancer. The validator client everyone's been waiting for has officially transitioned to the Solana mainnet.
For those who aren't familiar, Firedancer isn't just an upgrade, right? It's like a totally new engine.
It is. It's a completely separate implementation of the Solana software, written in Rust by the Jump crypto team.
And its main purpose?
Its primary function is to enable parallel processing of transactions. That massively increases the network's overall resilience and throughput. The expected impact is drastically increased transaction capacity. We're talking potentially millions of transactions per second.
And, more importantly, solving the reliability issues that Solana has faced in the past.
That's the crucial part. That reliability is non-negotiable if you want to serve high-frequency trading or large-scale national retail use cases like India is exploring. For this handover to succeed, you need guaranteed uptime and ultra-low latency. Firedancer delivers that technical guarantee.
And meanwhile, Ethereum, despite the broader market correction we've seen, showed some remarkable resilience. It's been recovering quicker than other top assets.
And that resilience is fundamentally technical. It's driven by its economic mechanics. While Bitcoin saw year-end profit-taking, ETH really showed the strongest recovery trend among the top-tier assets. That's a powerful monetary signal.
What are those specific technical drivers giving it that edge?
Two main components. First is the growing deflationary impact of the network, which I think is often misunderstood. It's not just about burning tokens.
Right, EIP 1559.
Yes, it's the measurable phenomenon where the token burn rate actually outpaces the new issuance rate, especially when demand is high. This continuous net reduction in supply, combined with more utility, strengthens its value. And second, the rapid expansion of the Layer 2 ecosystems. You have to mention Base and Arbitrum. These L2s offload the bulk of transactions, they lower fees, and they make the whole Ethereum ecosystem scalable.
So the L2s are the infrastructure that makes BlackRock's ETF even viable for mass use.
Without a doubt, they prevent the main chain from getting clogged.
So let's circle back to the overall market picture. Bitcoin saw the consolidation, stabilizing around $90,400. Is this stabilization a sign of fatigue, or is it more like necessary base building?
It's absolutely healthy consolidation. Analysts are attributing the correction to two things. Pretty typical year-end profit-taking after the massive run we've seen, and institutional rebalancing as funds close out their books. The $90,000 level is setting a strong new psychological and financial floor.
So what does this all mean when we look ahead? The long-term sentiment seems overwhelmingly bullish, and it seems to rest on this foundation we've been dissecting.
Without a doubt. The current price action is really secondary to all these regulatory and infrastructure developments. The long-term outlook is incredibly bullish, and it's driven by the 2026 projections that continue to forecast massive supply shock events.
Post-halving effects combined with this new, regulated institutional demand.
Exactly. A demand coming through all these new compliant vehicles we just talked about.
So if we zoom out for a final synthesis, the picture is pretty clear. We've seen regulation finalized in the UK and technical barriers lowered by the CFTC. We saw capital moving to proactive hubs like Abu Dhabi.
And national strategies shifting in Bhutan and India to leverage blockchain for real utility.
And underneath it all, infrastructure like Firedancer and robust Ethereum L2s supporting that entire transition.
The convergence confirms it. The global handover is fully underway. The focus has decisively shifted away from pure speculative trading and towards long-term utility, compliance, and building out that foundational infrastructure. This is the bedrock that allows the next wave of capital, the trillions that manage institutional wealth, to enter safely and with clear operational guidelines.
Which brings up an important question for you, the listener, to consider as we head into this newly compliant era. If global jurisdictions do overwhelmingly adopt regulatory rules based on the UK's model, this same risk, same regulatory outcome idea, does this new era of compliance unintentionally homogenize innovation? Or does that standardization simply provide the secure rails needed for the next $1 trillion of institutional capital to safely enter the decentralized ecosystem and ultimately speed up the adoption of technologies like tokenized gold and staked yield products? And that's a wrap for episode #65 of the Crynet GenShow. If there's one takeaway from this week, it's that 2025 has officially become the year of the stablecoin and the year of clarity. With over 70% of global jurisdictions now having clear rules, the Wild West era is firmly in the rearview mirror. Whether it's India integrating Web3 into its national economy or Abu Dhabi becoming the new capital of crypto capital, the foundation for the next bull cycle is being laid in stone. As always, you can find the full breakdown and links to all today's stories in the show notes. Thank you for being part of our community.
If you found this episode helpful, hit that subscribe button and leave us a 5-star review. It helps other builders and traders find the show. Stay sharp, stay decentralized, and we'll see you in the next one.